Oh, been trying to find it.
Lots of
So,
crap.
yeah. So awesome. Thanks again, Walt, for always bringing us some amazing CE opportunities. And now is just a really, really great time to find out kind of where we think the market's going to be going this year and see what your crystal ball brings for us. And I just wanted to give a little nugget. I was talking with my sales manager today and was reminded that Paragon is offering 30 days of Homebot for free for people that want to sign up. So I know all about Homebot. If anyone wants any more information, reach out to me, and we have a 10% off code for after the 30-day expires that I would love to get you guys set up on that and chat with you about the benefits of signing up for that. So with that, I'm just going to let Walt take it away, and I'm going to put myself on mute because I've got some workers here in the background.
Perfect. And then you can stop your video as well. So, and then you can
Okay.
bring your video back on here later on. So yeah, so, I highly endorse Homebot. I'll tell you that, for us, all of our clients going to Homebot, it's a great program, and the response rate that we get from people going in and clicking in there and looking at their properties and that, I mean, is unheard of. So we'll have anywhere from a 80 to 90, 95% click rate of people actually going in and checking it out. So I love Homebot and highly endorse Homebot. So we do have here in the background, I've got Susan in the background. So we may bring her on here as a panelist, but so we've got Susan. So everybody say hi to Susan. She is awesome LO here at Waterstone Mortgage, predominantly works within the Hispanic market. So, and then also, I'm not sure if you guys heard that DACA now, that FHA now allows for DACA. So for DACA loans, which is a big thing. Conventional had allowed for it, and conventional is a little harder to get into from time to time, where FHA now allows it, and we can do those. So we can help out all of your DACA folks going FHA. Trying to think if there's anything else here. We're going to cover a lot in this event. So anyway, all right. So let's go ahead and let me share my screen on. Let me see here. Let me go from the beginning. Sometimes this works and sometimes it does not work. So we will see if it works today. And if I can click through my slides, then awesome. And if I can't, then you guys will just have to see all my slides, because for whatever reason, I can never get that figured out. And it's not going to click through. So you guys will just see my slides on the left-hand side. So you'll know when we're getting close to the end. All right, there we go. Share screen, share here, boom, okay. So, and you should see my slides here. Make sure that's the case. Susan, let me know if it's otherwise. So here, if you this always has a tendency to move things around on me. Well, anyway, yep, you're good, perfect. So I try to be good. Anyway, if you guys go and if you you can change the view as to how the slides show and that, and so the slides should show pretty large. So we're going to talk about really the 2021 forecast here and what we need to do to plan for success. We do want to specifically look at, of course, the future, which we're going to do towards the end. We want to look at the past as to what we went through here in 2020. It was a pretty significant year for a lot of different reasons. Take COVID out of it, but it was a real significant year, a lot of challenges in a lot of sense, specifically when COVID hit, and that. So we're going to talk about that. As we go forward, really above all, the 2021 outlook hinges on the course of the coronavirus. That's really what 2021 is truly going to be hinged on. This is Jed Kolko, the chief economist at Indeed. And when he talked about that, this was previous to 2021. This was in December of 2020. He also said both the recent virus surge and the election make government emergency relief more likely, which we did see in with the Biden administration. We did see some more government interaction there. We saw another relief plan. I know they're talking about another one. So really next year, which is 2021, will also start to show whether two of the big pandemic shifts will endure, from services to goods and from in-office to remote work. Even small shifts in these trends, if permanent, could cause big changes in how businesses hire, how job seekers search, and where people live and how much they can earn. One thing that we've seen that I've started to see here over the last year was I've seen more and more people leaving California and some of the larger metropolitan areas, coming to areas like Salem, like Albany, like Staten, getting into smaller communities. One, they still make the amount of money that they made before, but the cost of living is less. Also, housing is less. So that really helps with business. But that also causes another shortfall of inventory, as we don't have a lot of inventory. So we'll talk about that a little bit on the inventory side, and I'll give some tidbits here at the end of what we may be able to do to help buyers get off the fence, but also help sellers to realize that they can sell now and they can move forward. But really, as we're moving forward, this year stems solely on the coronavirus and what happens throughout the virus. We know that more and more people are starting to get the vaccination. We know that they're sending the vaccinations out and they're making them as fast as they can. We know that in the state of Oregon, we're behind in the vaccinations as to where the governor thought that we would be. They're doing the best they can. And so it really depends upon how quickly we can get back to work and back to a, quote, normal economy, what that will look like. And we really don't know exactly what that's going to look like going forward than where it is now. So, and then the other thing is again, more and more people are able to not have to work at the office, but they're working in at home now. So that helps us out a lot. The Bureau of Land Services, it's not services. I keep messing that one up. Anyway, so the BLS unemployment rate, as you see it here in January, we're at 3.6%, 3.5%, 4.4%. The US has full employment at 5%. So in essence, in January, February, March, we were, for the US, we were really at full percent unemployment, where anybody that really wanted a job could get a job. They may not get a job in their current market or what they want, but they could get a job. And then when the coronavirus hit, unemployment rate spiked up to 14.7%. And then you can see it started going down. And what I want to pay specific attention to is October, November, we're at 6.9 and 6.7%, which was absolutely huge, that we were able to get a lot of these people back to work. The reason for that is that, again, Jed Kolko, Indeed's chief economist, he had said, though the labor market rebound is incomplete, and we know that it's incomplete, it hasn't fully rebounded yet, it has nevertheless surpassed expectations. In May, after payrolls plunged and unemployment spiked, the Wall Street Journal panelists of economic forecasts project unemployment would be at 11% in December 2020 and not fall below 7% until the first half of 2022. Let me read that again. So forecasters projected unemployment would be over 11 in December of 2020 and not fall below 7 until the first half of 2022, a milestone already passed in October. As we look at that again, in October, we'd already surpassed where chief economists thought that we would be in a year after that, a year and a couple months after that. So the economy has been rebounding. It's been rebounding pretty quickly to be able to get back to a more normal sense and to be able to help. We know that the mortgage market, it's really us, you guys selling homes, us lending money on homes, that is what's pushing the economy forward right now. We're the ones that are keeping the economy alive. We saw the same thing back in during the recession back in 2004 and 5. And don't forget that we are in a recession right now. And so, but still, it's we're seeing great strides within unemployment and within the economy. We're also seeing spending, spending starting here in January. You saw a little bit of a drop here in February and March, not much, but of course, as soon as, and this was consumer spending, of course, as soon as the coronavirus hit and we were all locked down at home, we started spending 31% less than what we had in years past. Pretty significant. You saw it start to release a little bit, where in October we were about negative 3.2%. Remember, we need to spend money to keep the economy moving. Of course, a lot of people tightened in, they stayed at home. Amazon did awesome. I heard a joke not too long ago that if we wanted everybody in the US to be vaccinated, just give the vaccinations to Amazon and they'll have it done by Saturday. So anyway, here in November, we see a little bit of a spike where we started saving a little more money than spending. And then, of course, as we went through December and January, we were back to normal spending for the holidays and that in December and then in January. So we are seeing more and more spending happening, which is what we need to make sure is happening to keep out of an inflationary world. Remember that inflation is a killer on bonds, on mortgage-backed securities, which is a killer on rates. So if we're not spending, rates can start to increase. Forbearance was also a big factor. If you're friends of mine on Facebook, I was very vocal about forbearance early on. I can tell you that I had a couple clients that went into forbearance that didn't close on their new houses that they wanted to purchase. So it was a big deal. It was a really big deal when that hit. So, you know, in April, May, and that. As we're looking here in May, we're at 4.76 million homes were in forbearance at that time. And you can see that it started getting better as we hit into July, again, as we hit into August. And then really it went down to 2.97 million as we hit in October. And more people were back to work. And then here in December 4th was last number that we had at this time, that it was down to 2.76 million mortgages were in forbearance at the time. So we're seeing less and less of this, again, as more and more people get back to work, and more people are able to pay for their mortgages. So Tim Dewey, he is with the University of Oregon. So I wanted to get a hometown feel here, a state town feel. He said there is nothing fundamentally broken in the economy that needs to heal. There was no obvious financial bubble driving excessive activity in any one economic sector when the pandemic hit. So a lot of our clients are worried about a bubble, right? They're worried about 2008 happening again. But here we have the Oregon Economic Forum the senior director of the Oregon Economic Forum at the University of Oregon, stating there was no obvious financial bubble driving excessive activity in any one economic sector when the pandemic hit. With COVID-19 cases surging again, it is understandably hard to look optimistically to the other side of this winter. Don't let the near-term challenges distract from the economic stage being set for years to come. Now, with this, we're again, and I'm preaching to the choir here. If you need some data or some material on this, we're happy to try to put that together and get it to you. And you can use the slides here. You can use this slide as well. There's still a lot of people that feel that we're in a mortgage bubble. We're in a financial bubble. Whether it's the stock market bubble, whether it's the housing bubble, whatever it may be, that we're in a bubble. Specifically on the mortgage side, we know that the differences of 2008 to now are literally night and day. So in 2008, lending guidelines were a lot less stringent. Today, you have to actually qualify for the mortgage, and you have to prove beyond any shadow of a doubt. Again, you have to prove beyond any shadow of a doubt that you can pay for that mortgage. That's what Fannie Mae and Freddie Mac requires. That's what FHA requires. And so it's harder today to get a mortgage than it ever has been, even though we try to make it as easy as we possibly can. But that's why we have the underwriting guidelines that we have. Again, it's harder to get a mortgage than it ever has been, which that has helped on any financial, specifically mortgage bubble. With that stated, we've got less inventory now than we ever had, that I've ever been in the business. And I'm cresting upon, I don't remember the exact date I started, but it was in February of 1998. So cresting upon my 23rd year here. It's today's time is so much different than it was in 2008. 2008, we had inventory. We don't have that inventory now. So that's something really to talk to your clients about and help them understand. And we have tools to be able to help with that. And we're going to show one here at the end. So a snapshot of year-over-year changes in key metrics. So we know that showings are up 64% from year over year. We know that purchase applications right now are up 22%. Pending deals are up 20%, 20.5. Existing home sales are up 26.6%. New home sales are up 32%. So pretty significant, pretty significant year over year changes here in the market. So again, here we're talking to the choir. Year over year, there's not as many new listings hitting the market. We know that total listings are down. I don't know what they are because I don't get the statistics for our county here. I was speaking to a realtor the other day that had mentioned that there was around 3 to 4 weeks worth of inventory in our market. I don't know if that's accurate or not. Last I had heard, we were around 1.8 months worth of inventory in the market. So either way, it's significantly lower. And we're finding that more and more people now are starting to move towards wanting to move, and they're getting past the time that they were having concerns with COVID and that. So Ivy Zellman, who's an economist, she had said, although the headwind of severe supply constraints in most markets has contributed to slight moderation in seasonally adjusted and year over year new pending contract growth for 2 consecutive months, albeit still growing strongly, the underlying strength of buyer demand, particularly for this time of year, remains apparent. So we know that with COVID, it has really created a pent-up demand. And with that pent-up demand, a lot of people are wanting to get out of their house. And they're going to start doing that as the economy moves forward a little bit more, and as more people start to gain vaccinations. They're going to start to come out of their house more and more. Now it's up to us to find that inventory to help with. So as we look ahead, really this winter may be one of the best winters for sales activity. And this was the chief economist for National Association of Realtors. So this winter may be one of the best winters for sales activity. That's a huge statement for Lawrence to make. On a winter to winter comparison, this could be one of the best breakout years just based on the fact that pending contracts are at such a higher level. We know that interest rates are at an all-time low, and they're predicted, Freddie Mac considers them to be at an all-time low all throughout 2021. So here they're looking at interest rates that were in 2020 at this quarter, the Q1 2020, we're at 3.5%. That was the average rate, went down to 3.2%. Q3 down to 3%, and then they're predicting that rates really would stay at 3%, or huddle, be around that. So of course we know rates are lower on a 30-year fixed right now than the 3%, but it's dependent upon interest rate. So I'm asked all the time, what's your interest rate? Well, we all have the same interest rate. It just depends upon what fingerprint or what loan-level price adjustments each client has as to what rate they're going to get. So we're going to see, right in that 3% range, and Freddie Mac is stating throughout 2021. That's a huge comment for them to make throughout the year here. So I was glad to see them do that. The Fed just met. I don't know if you guys caught that or not. The Fed just met, and they kept the Fed funds rate the same. And so that is a message to the market that they're not as worried about inflation on the market. More importantly than what they did is what the Fed Chair Jerome Powell had said. And he was asked if he was concerned with a bubble forming in the housing market. This is huge, guys, absolutely huge. He said that the high activity in the housing market and tightness has led to significant price increases, but that he thinks it will temper a bit. He is not worried. He is not worried. And it gives the Fed the green light to keep purchasing mortgage-backed securities and treasuries. Now, if you remember back in, it was like March, April of last year, interest rates, there was a 1 to 2 week period of time, and I'll always remember this time because it kind of scared the hell out of all of us. So it's a 1 to 2 week period of time where interest rates were fluctuating to extremes, to where you could call me in the morning and I would have a 3% rate for you. You could call me in the afternoon and the rate would be 4.5%. Literally the highest changes I had ever seen, ever. They would fluctuate 1.5 points on any given day. What was happening during that period of time is that the traders were having margin calls. And as they had margin calls, they went out to the bank to go get their money. And the bank doesn't have all the money there. So then they had to start selling their securities, their mortgage-backed securities, which then caused rates to go up and down. So then they could pay the traders to pay for their margin calls. So it caused rates to dramatically increase and decrease very, very quickly. Now, the Fed came in and they started buying mortgage-backed securities at that time to the tune, there would be some days where they would buy $10 billion worth of mortgage-backed securities, and they bought even a lot more than that. They started settling down around $3 billion to $2 to $3 billion. And if you think about that, I mean, that's a ton of money. They started buying those to be able to keep our rates low, which they have done. And they have been keeping our rates low for some time now, which they do that to spark the economy. So anytime that they're buying mortgage-backed securities and they're buying treasuries, they are trying to do that to keep mortgage rates low to spark the economy. So I think that's important for you guys to understand. As they start to see inflation prevalent, they need to kill inflation. So what they do with that is they will lower the Fed funds rate, which they already have lowered as far as they can, to spark spending. If inflation gets to be too prevalent, then we start to see 17% interest rates again. And when we see 17% interest rates again, it's going to kill the housing economy. So we have Jimmy Carter days again. As they see inflation is not as prevalent in the market, and they're not worried about us spending as much money, but they need us to start saving money, and the economy is going too fast can help us move into inflation. So as they start to see that, then they will start to hike the Fed funds rate to slow our economy down. Now, as they're hiking the Fed funds rate, they are hiking not mortgages. They're not hiking mortgages. Remember, they can still be buying mortgage-backed securities on this hand, and they could be raising the Fed funds rate. So they could keep the mortgage rate the same, but as they start to hike the Fed funds rate, that's sending a message to the market that we need spending to slow down. And as spending is slowed down, they will hike auto loans, home equity lines of credit, credit cards, all those things that our short-term money is based upon. And remember, what they are changing is the Fed funds rate, which the Fed funds rate is the overnight cost of funds that each bank charges each other to borrow money from one another. There's, and I forget, it's either 3 to 5 banks that can physically borrow money from the Fed. And that's the cost that those banks are able to borrow money from the Fed as well. So, but again, what I really enjoyed what he was saying is he's not worried. I remember as he was talking, there was one news person that had said, we're seeing a 10% increase in value in some areas, and he had said that's healthy, and he is not worried. So that's significant, very significant. So Daniel Hale, the chief economist at Realtor.com, he said, we expect home sales in 2021 to come in at 7%, above 2020 levels, following a more normal seasonal trend and building momentum through the spring and sustaining the pace in the second half of the year. So starting to become faster and faster. So we're looking at expected home sales to be up 7% from 2020. So that's a significant number. While home sales are expected to lose some momentum over the last months of 2020, the shallower than normal seasonal slowdown creates a higher base of activity leading into 2021 that is roughly maintained for the first half of the year. Again, this is key. As vaccines for the coronavirus become broadly available to the public and economic growth reflects the resumption of more normal patterns of consumer spending, home sales gain even more in the second half of the year. So we're already going nutso right now, right? It's hard to find a house. One thing that we've started doing is we are pre-underwriting some of our files to help our clients have a unfair competitive advantage to where we can close quicker. When we send our pre-approval letters, we're stating that our file is fully underwritten, approved, not just pre-approved to the industry standard. And that's significant because pre-approvals, we've just ran it through Desktop Underwriter or through our automated underwriting engines, whether it's LP, DU, or GUS. But then, if it's fully underwritten approved, our offers are as good as gold. The underwriter has seen the file, we're good. So we've done that to start to help our clients have an unfair competitive advantage. Here he's saying that in the second half of the year, as more and more people get the vaccines, we're going to start to have even a faster second half of the year, larger sales in the second half of the year than what we saw in 2020. and that what we're going to see in 2021. So that's huge. So this is Frank Nothaft, terrible names. He's the chief economist at CoreLogic. And he had, so here I'll give you what he had said, but I found this to be very interesting and thought that this would be a good thing to be able to share with clients as well. CoreLogic released their home price index report for December, showing that home prices increased 1% during the month and 9.2% on a year-over-year basis. So home prices increased 1% in December nationwide. Now, of course, we know that numbers are specific to regions, right? And specific to neighborhoods. But that's huge. This is a significant gain from the 8.2% year-over-year number reported last month. This was the highest annual home price gain since February of 2014. Inventory was down 24% year-over-year. So our inventory is down. We've got 1% gain just in December, 9.2% gain for the year. We know that Fed Chairman Jerome Powell was talked about 10% this year. So pretty big. And here Frank gave a reason for the lower forecast. And that was, he said, prospective sellers with adjustable timetables have opted to delay their listing their home until the pandemic fades or they are vaccinated. Now we're going through that now, getting more and more people vaccinated. We can expect more inventory to come available in the second half of the year. So he's stating because of the inventory being down 24% year over year, he's confident that as soon as more and more people start to get vaccinated, at that point, they're going to start listing their houses. And we can see that. We can see that pent-up demand. Here are some of the top states with top appreciation. Idaho had 19.1% appreciation last year. Huge. Indiana, 16.1, Maine, 15.2, and Maine already had high prices anyway. Top metro areas, 13.7% for Phoenix, 10.4% for San Diego, and Washington was at 8.8%. So pretty huge. And as we're looking at CoreLogic, they're the ones that gather most data in the US and really start to go through that. Prospective home sellers with adjustable timetables have opted to delay their listing until the pandemic fades or they are vaccinated. So we're looking at, what is that, June? They're hoping that everybody can be vaccinated here in Oregon, June, July, August. So that's where we can see that second half of the year really start to blow up for us in a good way. So home price forecasts, last 12 months, Zellman was saying that we could increase 5.9%, CoreLogic 1.9%, Realtor.com 5.7%, NAR 4.7% for the forecasts. We've already got others saying it's as much as 10%. So it's going to be in there somewhere. We know that homes are going to increase in value next year. I also found these numbers to be very interesting. New home sales, which measures signed contracts on new homes, were up 1.6% in December. So again, new home sales were up 1.6% in December, which was slightly lower than expectations. Sales are still up 15% year over year, so pretty significant. Inventory went from being down 13% year over year to down 6%. And this was the year-end numbers that we ended up receiving with this, likely due to some new supply we have been seeing in the housing starts report. This one blew me away. Homes that have been sold but not started are up 33% year over year. Homes that have been sold but not started are up 33% year over year. So more and more people are wanting to build. They're going to builders. They're, and of course, here we've got that going on as well, where we had 300 plus families lose their homes up in the canyon that need to be rebuilt. So we're seeing some of them starting to come down and buy homes down in the valley, not in the canyon. And so, but a lot of them are starting to build up in the canyon, and so I could see where homes that have been sold but not started could be up 33%, and I can see that continuing. More and more people are starting to look at construction. We're getting a lot of calls about construction, so pretty big. Now, foreclosures were always a big thing. We were talking about, anytime that you're talking about a bubble, there's foreclosures, and with forbearance, a lot of people are worried that that's really going to kick in a lot of foreclosures. The reality is that people have more equity in their homes today than they ever have, since I've been in the business. So they've got a significant amount of equity. Most people, if they run into problems, they're not going to just leave that equity. They're going to sell their home. And they can sell it at a discount now, where in 2008, they couldn't do that. 2008 home values were more than, what they owed was more than what the home value was. That's what led to a lot of foreclosures. That's what led to a bubble. And so lending guidelines, got tight very, very quickly. A lot of lenders went out of business. Again, people owed more on their homes than what they were worth. So people just said, you know what, I'm just done. And they just walked away. Here today, more people have more equity in their homes than they ever have. So it's big. So again, Lawrence, the chief economist at National Association of Realtors, he said any foreclosure increases will likely be quickly absorbed by the market, which I could see that. It will not lead to any price declines. So he's pretty darn confident. I know they watch this stuff very, very closely. It will not lead to any price declines. So we're also looking at, not on the foreclosure side, but on the home sales side. There was a recent report that I saw that they've found that most first-time home buyers are between the ages of 30, I think it's 30, 32, and 39, right in that ballpark. And those are the ones that are starting to buy more and more homes these days, and starting to buy homes. We have more of those ages of individuals hitting our market over the next 6 years than we ever have. And so more of those individuals are starting to hit the market, hence more demand is hitting the market, which we just can't build houses fast enough to be able to help take care of those. So one thing that COVID has taught us is really the value of virtual events. This is something that we used to hold this event in our office, and we would hold it in our office. We would do an hour-long, lunch and learn, brunch and learn, whatever you want to call it. We would have 10, 15, 20 of you in our office. And it was great to be able to shake hands and say hi, and a much easier way to be able to connect, because I could see you. In this webinar, I can't see you. I can see the number of participants, but I can't see you. And so what we found is that with the coronavirus, and really, I'm going to state the new way of doing business, I'm placing a much larger value now on virtual events. We ended up taking this event, Tracy and I, as soon as we saw everybody was home, they needed things to do, they needed to keep their mind off of what was going on. We switched this event from monthly face-to-face to weekly. And we just started, giving you data, giving you information as everything was changing so fast. As everything started to settle down, we then went to every other week. then we took a couple months off right before the holidays. And during the holidays, we did about 3 classes during the holidays. And then we've started to pick these up again, where we're starting to do these every other week. So love to have you come in to our next event. There will be more information following about that. The other thing is that we're finding that we're starting to do more events like homebuyers classes, homebuyers seminars, budgeting seminars, credit seminars to the general public, and we're doing those via webinar as well. And so Tracy and I'd be more than happy to team up with you guys to map out how we do those, and then help you do those as well. And so I can tell you that I consistently do a homebuyer class once a month, and we have a good amount of people in that class. I've been doing that pre-COVID, and it's been a great class. It's been a great opportunity to be able to share, but it is a great way. So Eventbrite, they had said that virtual events exploded in popularity due to the pandemic, but they're proving to be a high value opportunity regardless. Not only can they be just as engaging and exciting as in-person events, they allow you to bring together a wider audience. So, we're finding, at least in the homebuyer seminars that we do, that we've got some people that are coming into the homebuyer seminars that are looking at property in Oregon, in Salem. They're not, and they're from out of the area. So they can be really a big thing. And we're starting to see more and more of these come to play, as I have a lot of friends, mortgage related and also real estate related, realtors throughout the nation. I'm seeing more and more of these. So again, happy to be able to do these with you guys. Want to switch here and go to a total cost analysis. Sorry, my phones are going crazy here. Share screen. Share my screen. Okay. So one thing that we said is in this, we wanted to talk about how to help your clients kind of get off that fence of potentially listing, of not listing, and that. And one thing that that we know is that interest rates are going to start to increase, right? So we know that we don't know exactly when. Is it what Freddie Mac is stating, and it's not going to happen until 2022, the end of 2022? One thing that I know, in being in this business as long as I have, is that interest rates will increase overnight, and they will do it fast. They have a historic pattern of doing that. They will go up fast and they go down slow. So it takes a while for them to go down slow. So one thing that I did here is I did a report, total cost analysis. And with this, I wanted to show at a 2.5% rate, at a purchase price of $350,000, what the monthly mortgage payment was. And let's just say this is the tale. I'm going to tell you the tale of two brothers, brother A and brother B. So brother A bought a house last year, got a rate of 2.5%. Again, this is fictitious. Got a rate of 2.5%. Bought a house at $350,000, and his principal and interest payment was $1,382 a month. Brother B buys a house in a year from now. Interest rates are 3.5%. He can only afford what his brother A, could afford, because he's in a trust and he's getting money on a monthly basis, and that's the only money that he has. So he can only afford what his brother was able to afford as well. So that's $1,382 a month. For him, because he bought at 3.5% for an interest rate, he can buy $307,970. Now take the appreciation side out of it, because we know that if brother B purchased a year later, we know that $350,000 house is going to be more, and that 307 house was less expensive a year ago, but yet, so take the appreciation out of it right now. Just on the pure side of buying a house at 3.5%, brother B could afford 307. So really 308 total. Brother A was at 350,000. So that's a pretty big difference between those two. I mean, we're talking $42,000 or so difference between those two. And we know that $42,000 for buying power in our market is huge, absolutely huge. $42,000 can make or break the deal. $42,000 can get it maybe an extra bedroom, which could help the client be a little more happy in their house. $42,000 can be really big. But let's look at what happens to these two over time, because they're going to keep this house certainly past 5 years, but they're going to keep it a total of 15 years. And at 15 years, they're both going to sell, and then they're going to go to Cancun. So brother A, he bought his house again at $350,000. His total net worth would be roughly $520,000 over that period of time. Brother B bought his house at 307,9 something. So basically 308, 307,970. So basically again, 308. But his net worth is $446,799. So that's what, a $70,000 difference between net worth over 15 years. If we're looking at that with our clients, we need to help our clients understand that sooner rather than later is the best time to buy. And we can do this report specifically for your clients and show them, if you sold today, here's what your loan could be, and we can increment the interest rate up. But over 15 years, I mean, just a 0.5% increase of interest rate, you're talking about almost a $40,000 difference in net worth between a 2.5% and a 3% interest rate over a 15-year period of time. So we know that a lot of real estate is driven, it's emotional. And so people, that they want to get out of their house, they're looking at another house, and maybe they've started to lock on another house, specifically the owner occupied. It becomes a little more emotional. And so, but if we can get to the numbers here, if we can get to the numbers side, and if we're looking at a $40,000 difference, maybe the husband doesn't want to sell and the wife does, but if we show them the numbers, maybe then he'll want to sell. We're also working with a lot of move-up buyers that, their servicers are calling them and wanting them to refinance. And I had a client not too long ago that made a $70,000 mistake, and he refinanced with his current servicer. The servicers are not talking to the clients about how long they want to stay in the house, are not talking to them whether the house is working for them or not. The servicers are just saying, hey, can we save you some money? And that's noble and that's great. But for this client, he doesn't plan on being in the house more than 5 years. And we were going to refinance him from an FHA loan into a conventional loan when the time was right, to avoid his mortgage insurance and help really start to save that money. His current servicer refinanced him into an FHA streamline loan, which he went from an FHA into another FHA loan. Right there, he's going to have another 1.75% mortgage insurance premium financed on top of the loan amount. So it cost him $4,500 just to do another FHA refinance. With that, he also didn't get the lowest rate that he could have gotten. He still has mortgage insurance. So there's no way to get rid of that mortgage insurance unless you have, unless you sell or refinance. And so what ended up happening for him was when I did his mortgage review, he was excited because he he was saving $291 a month, which is massive, right? Absolutely massive. I was heartbroken when I told him that we would have saved you $521 a month on the right strategy. So servicers, they don't care about your clients, and these are your friends. These are your past clients. So one thing I would say is that, really talk to your past clients. Now is a great time to be able to do it. Talk to your past clients, find out if the house that they're in is still working for them. Find out if their mortgage is still working for them. If they need a mortgage review, we can do a mortgage review for them to see if the mortgage is the right thing for them, or if there's another mortgage that could be better for them. More importantly, we're going to ask the questions to find out if their house is working for them. Because, it's a great time to sell. It's a great time to buy. And it's a great time to be able to buy to get the lowest possible rate, because as we look at these numbers, rates significantly lower what you can purchase the higher that you go. And if rates were all of a sudden to pop up to 4% overnight, let's just say hypothetically they did, instead of buying 350 and at a payment of 1382, instead of buying 350, you're now buying 289.6. So that's a $60,000 difference if rates all of a sudden popped up at 4%, which I've seen them do, and so they can. So I think there was one question that came through. I don't know if you got that. Let's see here. Yep, we'll send out copies, and I'm also recording this as well, so we'll send out a recording to you. So perfect. All right. Well, Tracy, back to you. Thanks again for having us. Thank you for sponsoring our event and giving the CE.
It's really easy to sponsor them now. Sorry, I couldn't bring lunch in. But I also wanted to say thanks to my team who are also hiding there in the background here. So Kelly Ferguson, Cinda Brendage, Katrina. I'm drawing a blank on her name. Anyway, Katrina and Annalise and Heidi down in Albany. So they're all here supporting you guys too. So if anyone thinks of any other credit hours that they want to see, send us a message. We'd love to have some more topics and some more content to bring you guys some more hours. So thanks for hopping on.
All right, guys. Well, if no other questions, I think we're good to go, right?
Yep, we're all good to go. And I will be sending out your CE to you. And yeah, so you should be seeing that in your inbox later on this afternoon.
All right. Thanks, guys. Have an awesome day. We'll see you soon.
Bye-bye.